Hello everybody, this is Daniel with Daniel's Bullion Coins, and I'm looking forward to just doing a quick overview on some of the other videos that I've done and just add in a few little notes. This one here has been ongoing for quite a while, but what I wanted to talk about was where we were talking about the money, the dollars coming out of the system and going into gold and silver and going into tangibles. Something that I've noticed lately, that I said this, I drew this for stagflation in the other video, how I believe we're going to start seeing stagflation. And it's funny, I did this video, I think on Friday, and over the weekend, Saturday and Sunday, there were 4 or 5 other YouTubers that are saying the same thing that they're seeing. They're starting to call for stagflation. We've always wondered, would it be inflation where the things keep going up, or would it be deflation where people quit buying things? Well, it's both. It's stagflation. People are spending like crazy to get tangibles, food, farm, necessities, whatever, and gold and silver. They're switching from dollars and from stocks over to something that has real true value. So, but that's created another thing that I've noticed this weekend. A situation I ran into was so many people came in to our coin shop wanting to purchase precious metals, and they were bringing cash. And by the end of the weekend, we had taken in more than $10,000 in cash. And when we go to deposit anything more than $5,000 into our checking account, they actually charge us a percentage of that in order to deposit that money. So, well, that's all well and fine. It's just a charge, but I bet you in the future that those fees start to go up, and we're already seeing an increase Monday morning in what they charge to deposit cash if it's over $5,000. The banks have a thing that's called structuring. They came out with it a few years ago, and what it is they monitor everybody's account. So you have a limit of 1,000 per day, or 2,000 per week, 10,000 per month, and I think it's 100,000 per year. You have to check with your bank, on the specifics, but there is a limit. You can't just go in there every day and deposit cash and not have them notice. They will turn you in. In fact, the tellers are rewarded for turning people in for too much cash and structuring. And they are not required to notify you that you're being turned in to the IRS for structuring. Now, when I went to my wholesale supplier with more than $10,000 in cash, I had to fill out an 8300 IRS form to explain where that money came in. But I'm in the business, I'm in the cash and gold and silver, like if you were in the pawn business. So it's a little bit justified, but still, you don't want that extra hassle. You don't want to be throwing up any red flags. So we'll be taking more checks now, and it'll be inconvenient because you can't write a check and carry your material out of the shop. You have to wait for the check to clear or the credit card to clear before you can carry. Now that's no problem for the larger coin dealers, because they receive the funds, cashier's check or whatever, credit card, and they wait for those funds to clear before they ship out the gold and silver. With me, the advantage is, and the reason it costs a little tiny bit more to come and deal with us, is because you can cash and carry from us. But now that's starting to be a problem with the limits on cash, and plus our business is growing. Now, when we took cash before, it was no big deal because there'd be somebody coming in to sell a few days later and we could give them cash. But now there's way more people buying, and buying in much larger quantities than there are people selling. There are people selling, curious to know. It's unfortunately lower income people, where 70-80% of their income goes to energy and food. And so they're feeling the brunt of it, and they're needing cash more so than upper class right now. And the upper class people with money are starting to go into precious metals. Okay, that's enough on this one. We've done a lot of videos on this. You can go back and watch those. I'm not going to talk about fair value or fertilizer today. Maybe a little bit on fertilizer. We'll see. This is the chicken one that we did. This is interesting. Nobody had noticed it, but I wanted to see if anybody would notice that the chicken price was the non-GMO chicken compared to the non-GMO chicken from the early 60s to right now. It's 25 cents. It's a silver quarter back in the 60s. And today, the apples for apples, chicken for chicken, non-GMO, farm-raised chicken is $25. But you can go to Walmart and you can get a rotisserie chicken for $5. And you say, how does that fit into the mix? Well, it fits in perfectly with the value of a silver quarter. Today, that silver quarter is worth a little bit more than $5. So you can trade that silver quarter and get a chicken, a rotisserie chicken. Now this is the this is not the non-GMO chicken. This is the chicken raised with all the accelerants, all of the antibiotics, all of the growth hormones. You know, it's funny, you go back and watch a video from the 40s, 50s, 60s, even in the 70s, and how slender everybody is. And you look at people nowadays, how poor our health is. And it's because of this $5 chicken with all of the hormones and natural gas that's pumped into it and everything. So that is equal to the 25 cent quarter today. But if you go back to a chicken with manure fertilizer feed, the feed has been grown in all natural fertilizer, all natural manure, you make it much more difficult to come up with it. That's where your $25. So you can see from $5 to $25 the huge discrepancy in natural gas feed and manure feed, manure grown feed. And this is what I say that the collapse is going to be. One of the reasons that I see the collapse being so severe is the fertilizer problem that we have. We all know that natural gas feed, natural gas is going higher. It's inevitable. Everybody's talking about it. Every country, fuel prices, everything. So that's going to equate into higher. That's going to equate into a higher $5 chicken price. And if we unhook from natural gas and go back to fertilizer, then this calculation of silver to $25 will work out to $280, just like we talked about in the other video. This is the math for that. This is the amount of silver that's in the quarter, 0.18 of a troy ounce. You divide that into 1 full troy ounce, so you can find out the value of 1 troy full ounce, and you come up with 5.55 chickens. And so you times the 5.55 chickens by the $25, and you've got the $138. That is for just the non-GMO chicken. Now, if you want to do the manure, you need to double it right there. So this is the chicken. This is the silver quarter right here, 0.18 of a troy ounce, 1 full troy ounce, because we want to find out what the price of a full troy ounce, what it's worth. Ultimately, we're looking for the value of a troy ounce. 5.55 chickens, 5.55 chickens times the price of a farm-raised chicken is $25, and that's the natural gas price. If you want a manure-fed chicken, you're going to be $50. That's why we double it here to $280. Okay, so that's just a quick little touch up on that. We've got a full video. You can look back on that. Then we talked about the silver to gold ratio here. So we've got silver and we've got the gold column right here. And this is troy ounces. And we were talking about the crust and how in the crust it's approximately 20 to 1. The yield, I want to talk about the yield. What the yield is silver and gold comes out of the ground at this rate, 10 to 1. The miner, the natural rate is the miner, and he's working to get that silver and gold out of the ground. So his time and his energy and his effort is measured 10 to 1. So in other words, if one fella goes out with a shovel and digs for silver and all week long, mines for silver, he's going to get approximately, let's say, 10 units. You can call it a tenth of 10 grams or whatever. say take 10 grams. He finds 10 grams of silver in 1 week. I'll tell you what, that's for fun. Let's call it 20. Let's try it. Let's try an experiment I just came up with off my head. Let's say he comes up with 20 grams. And the fella goes out by the river and he comes up with 0.02 grams. So that is what's going to happen. Equal effort, equal time. One spends 5 days digging, one spends 5 days panning. This one comes up with 0.02. This one comes up with 0.20. So that's the 10-to-1 ratio that the miner is going to have at the end of the week. And these two guys, they go to the farmer and they want to trade for milk. Well, it took a week worth of effort and time to feed the cow, milk the cow, bottle the milk, and trade it on Friday. Same with the wheat. Grow the wheat, cut it, grind it, make the bread, 1 week. So these people trade equally. And it's 0.20 of a, this is round numbers, because we know that it's 0.18 for a quarter, a silver quarter. They trade a silver quarter for that bread and that milk. Or 0.02 grams of gold equals the same amount of labor, effort for the milk and the bread. So we come down here and we did the 10-to-1 ratio at today's price for the gold. Would be 185. Now, 185. If we go back to a question that we had the other day about when do I sell my metal, and we were talking about how the price of metal goes down, it comes up, it goes down, it comes up, it goes down, it comes up through history. And from the 1960s, it had fair value. And then in the 1980s, early 80s, we had fair value again. That's when the price of silver caught the goods and services, this black line. In 2000, we caught it again with Enron. So it dipped down again. This is an inverse. It dipped down again, and it got to the price right here. It came up, but it did not actually touch fair value. The price of gold was approximately 2,000 for round numbers. And the Dow was 6,000 for round numbers at that moment. Fair value would have been 4,000. If these two had met somewhere in the middle, it would have been 4,000. Maybe they would have met at 3,000. Maybe they would have met at 5,000. We don't know. It just depends. But we can say 4,000 would have been the middle, just for round numbers. So if we had allowed this to run up and catch goods and services and found fair value, we would have been right here at 4,000. So we did not actually catch fair value, and we have not caught fair value in a really long time. So if we put fair value in here just on today's market, you know, we could say 3,000. A lot of people say that the fair value right now is 3,500. That would put silver at $350 at fair value for today, for today's calculating. Now, that's not including throwing in fertilizer problems, or, you know, I mean, well, yeah, it is the fertilizer situation, but I think it could overshoot. It could get a lot worse. But let's just look at historical numbers. And so here we are again, triple digits, you know, north of $250, like some of the other charts that we have done. So we talked a lot the other time about JP Morgan and the paper that they are using to get this price. They have it right now at 85 to 1. That's because they produce sometimes as much as 500 but maintain pretty much 250 pieces of paper to every one tangible ounce that they back it with. And I had mentioned that they have gone from 0 to over 300 million ounces just in the last 10 to 12 years. That silver is considered house silver, and it does not back up or secure any of their paper trading. It's in a different booking. section. So if they collapse or there's a collapse in the economy or whatever, they're not liable to use their silver for reimbursing people. They're going to keep that silver to themselves. That's JP Morgan, and that's how they have that silver listed as house silver, so that they don't have to reimburse anybody with it. Okay, so if we have time, I'm just going to do a really quick overview of something I've noticed in a lot of the chats. I watch a lot of YouTube, I read different books and talk to a lot of different people and gather a lot of information. And the purpose of my videos is to compact that information down to basic, understandable terms and put it on a whiteboard and make it as simple as possible for me to understand and for other people to understand that aren't into this. I mean, some people are truck drivers and they're teachers and they work at a gas station or whatever, and they're not economically savvy. So I try to make this very, basic and simple. I round numbers up. I just do a basic overview. But I noticed a lot of people in the comment section on these other economic channels are they're trolls is what we call them. They're bitter and hateful people. And I think that that's systemic to problems in their life, because it just doesn't make any sense for people to be so bitter and so hateful. And one example of that is towards gold and silver economic people that are making forecasts and trying to educate others. And I'm thankful for the ones that are learning and taking the information in, and I understand that it's just the bitter people that tend to leave comments. But I wanted to use them to explain a point that everybody's missing, that a lot of those guys are missing. So we know that the market is cyclical. And what that means is it goes up, it goes down, it goes up, it goes down, sort of like that. And this is a little bit of everything. This is whether you're talking about real estate or gold and silver or commodities or ETFs or whatever. They go up and down. And some are going up while others are going down. So I can overlay two different, I wonder if I can try to do that, see if it'll make sense. I don't know, we'll try it, see how it goes. Other things are doing the opposite. Commodities, gold, silver. And the trick to being successful in not letting bitterness blind you from an opportunity to better your situation in life and leave a legacy for your family. That's really what this is about. It's legacy wealth. And here we are, we've got commodities, gold and silver, exchanging position on what is valuable, what is not valuable. Properties going down, silver and gold are going up. So what you want to do is you want to start out down here. You've got a small amount of money, and you invest that money until you realize that the thing that you're investing in has turned into a bubble, or historically it doesn't look very good, and you say to yourself, it's time to get out of that and go into something else. So maybe you're in real estate here. I'll use myself as an example. I was a carpenter. I was in real estate right here. I was watching real estate climb, and it got astronomically high. And I would tell my partner and my friends, I said, something isn't right. This is climbing way too fast. It's a bubble, and I've seen it before, and it's gonna end, and we're gonna be without work, and we're gonna be hungry. So when it got to its peak, I said, what can I change over to? What can I invest in that will be better or different than what I'm doing right now? I started to look around, and I realized how cheap silver and gold were at the time. I said, wow, silver and gold are really low. Let's take my money and everything and start to put some money into silver and gold. So we add those, we add it to it. Instead of going down, we're catching it. We're catching it going up. We're just bringing this line right here up to this line. and we're continuing the growth instead of falling with the market. So back in 08, we'll do 2008 right here, when the market started to crash and everybody was saying, buy the dip, it's going up, it's been going up for 10 years, it's not going to stop, it's going to keep going. Well, that's the time to get out, because there's no logic in that. And you look at the price per earnings, and you can see that it's about to crash, and you can see by what you're getting paid per day to be a carpenter, you can say to yourself, this isn't normal. So gold and silver rose to this point, and there was a time when I started to look around and I said, wow, the price of, started to look around again, put my eyes out again, the price of property is really low. By this time they were auctioning off abandoned homes, they were foreclosing and just clearing stuff out. So I said, well, it's time to get out of gold and silver and get into some property. So I believe it was 2015, let's say. We found a piece of property that was being auctioned off, 8 acres, 3 bedroom, 2 bath, horrendously needed work. So there again, you have to be have some skills, develop these skills where you can tackle these. If you can't, learn each step one as you go along. And we said it's time to buy property, real estate. And so we bought this farm, which I just did a farm tour on Peace and Plenty Homestead. If you want to go watch that, it's a complete tour of the whole farm. We bought this place, we paid $30,000. We're 1 hour south of Washington, D.C., and we're 1 hour north of Richmond. So it's not, in Idaho or Alaska or something like that. This is prime location right here for $30,000, 3 bedroom, 2 bath. Now we've put a lot into it, and you can see that in the homestead video. So we bought when it was really low, and we've been able to improve that property. So there again, we've just taken and we're connecting these two. We're just connecting these two together. We're bringing them together and connecting them so that this line can go up twice as fast as buying. If I had bought stocks and just held them through 2008 downturn when stocks when the Dow got to 6,000, I think it was at 14,000 when it peaked. If I had stayed with the buy low, sell high principle, I'd be down here somewhere. Now, when the Dow is up to, I believe it was 17,000, when I took that opportunity to buy the house. Now, you have to have a house, and so, and I didn't think the Dow was going to go any higher than 17,000, so I was wrong on that one. But we saw the opportunity to buy a house, and you have to have a house. It's a good, tangible investment, especially if you're going to turn it into a farm. So that's what we did. We turned it into a farm, and the value of that farm has significantly increased. And we're back up right now, right here. And we're starting to see the Dow. Here it is. I believe it got up to 33,000, might have been a little bit higher, and it's starting to go down again. And we're hearing the same thing from everybody. Buy the dip, stay in. Don't get out right now. It's going to recover. You're going to get rich. And a lot of people are saying that because they need everybody to stay in so that their thing so they can get an opportunity to get out. So that's happening a lot. And you have to keep in mind the stretch, the time between 14,000 and 17,000, that was about 10 years. And from 17 to 33,000 was another 10 years. So have you got 20 years to wait for it to go from 33,000 down to probably 4,000? Like we said in the other video, we're able to say fair value could possibly be 4,000, and then to see it one day get to 33,000, that could be 25 years. That's how long it was from the Great Depression, and they weren't nearly as overvalued. Price per earnings ratio, they were not nearly as overvalued as they are now. But that's not to say that you can get out of ETFs right now, and you could possibly get into commodities on the Dow and ride that up. That could be the next. I'm thinking maybe possibly doing that right now, putting a little bit of money into commodities. I think they're up 30% this year and 60% over the last 5 years, and I think they still got a long ways to go, because when everybody crowds in there, and plus with inflation, the nominal value of the dollar will go much higher, and if you're in stocks, you can nominally increase your dollar holdings. But if you wanted to, you could come out of ETFs, you could come out of just regular cash, you could come out of these things and go into silver, and you could ride the silver train much higher. And when that's where we talk about the value of silver compared to the Dow and the chicken and the gasoline and all of those other things that show us history. And we're talking about 6,000 years of history when we talk about what is the value or the next leg up for silver and gold. It's just like property. When we were down here looking at property, we thought that this was it, you know, that we say, well, look, real estate is going higher, and it's really low, and it's going to return back to its fair value. It's going to return back to fair value. So that was the time to buy. And we can look at 6,000 years worth of history here, and we can say, where's fair value? It's going to find fair value again. Let's look around. Let's study what's going on. Let's think about this. Let's decide for ourselves. I'm not giving you financial advice. I'm just showing you what we did and what I'm doing. How I was in the carpentry real estate venture here, and got out of that and got into silver, and then got out of that. And I'm trying to get everybody else to get out. I'm trying to explain, and you study on your own. This is not financial advice. This is just what I'm doing. And you can see how when you connect this, it's a shorter amount of intervals compared to this. This is a much larger, you know, you're talking 20 years, 25 years here, probably another 25 years to go from the 33,000 in the Dow, ride it down, and then ride it back up someday. You know, minimum of 25 years, because we've never had the economic numbers on price per earnings ratios and other non-performing companies. Look at Tesla. The only way Tesla makes any money is taking the credits that they get from the government, the financial credits that they get from the government, and selling those in the open market to other car companies who can't meet the federal government's requirements. They buy those, they tack it onto the price of the car, and Tesla posts a profit. But yet their cars lose money every time they sell one. And yet the stock for Tesla carries the Dow. Well, thank you so much for watching. I really appreciate it. I could probably sit here and go on and on forever, but I really appreciate everybody's time. Thank you so much.